All right, futures are headed down on this Wednesday morning. 30 minutes till the start of the cash trade. I'm Matt Miller.
I'm Danny Berger. Bloomberg Open Interest starts right now.
Coming up, Brent tops $90 again. The IEA proposes what could be its biggest emergency oil reserve release of all time in a bid to cool prices.
Oracle surges after delivering an outlook that signals no slowdown in demand for AI computing.
And private credit remains under pressure. JP Morgan pulls back. PIMCO warns of sloppy underwriting, and Apollo pushes for transparency if it can achieve that.
Yes, they want more trading. They want transparency.
They're working on it. They're working on it.
We'll see what happens there. In the meantime, Matt, I am looking at Oracle shares this morning because this is the bright spot in this market. At least we can allay some of the AI spending concerns to the side for now. A rally of 9% in the pre-market. Their cloud sales showed sustainable demand for its AI products. They raised their sales outlook, and it maintained its $50 billion worth of spending plan for AI of this year. So no raise in spending, and sales and revenue look good, Matt.
Burning through cash, though, right? $11 billion in Q3, and their weighted average cost of capital is 12%. So high hurdles. Uber has struck a deal with Amazon's robo-taxi unit Zoox. Riders can book Zoox taxis on the Uber app in Las Vegas this summer before that expands to Los Angeles next year. And normally I would just highlight really the move in the share price, but I will also point out that the CEO of Uber, Dara Khosrowshahi, will be on the show later on this morning, and we can see Amazon, which owns Zoox, not moving much at all. Watching oil really is the highlight as the market grapples with rapidly shifting comments from the Trump administration about, did we escort a ship through the Strait of Hormuz or didn't we? The Energy Secretary posted a message that the U.S. Navy had done that and then deleted that message minutes later. Then the White House conceded actually the operation had not occurred. We spoke with Renee Kofod-Olsen of the V Group yesterday, which manages ships trying to get through the strait.
I think all shipping companies want to find solutions to this, to your question about Navy escorts. But right now, it's not there.
The International Energy Agency has weighed a massive release of emergency oil reserves, potentially up to 400 million barrels, which would be the largest in history. Bloomberg oil strategist Julian Lee joins us from London. And Julian, I wonder why this isn't having more impact on the price, or maybe it was priced in when we started to get the inkling that this would happen at the beginning of the week. But how helpful would that be, 400 million barrels?
Well, it will undoubtedly be helpful. And, you know, this kind of a situation is exactly what the Strategic Petroleum Reserves and indeed, to some extent, the International Energy Agency were created to deal with. A physical loss of supply on a very substantial scale. What's going to be important is not just the overall amount of oil that they're talking of releasing, but the rate at which that can be released onto the market. There are constraints on that in terms of just, you know, the physical ability to shift barrels through pipelines. And also, I think, you know, the way these strategic reserves are structured in different parts of the world. In the US, it's all in crude, it's in salt caverns along the Gulf Coast, and it's owned by the government quite clearly. In other parts of the world, it's quite different. A lot of it is refined products, which is great at meeting demand relatively quickly because you don't have to produce it. But a lot of this is held by companies under arrangements with the International Energy Agency and with governments. And these haven't been tested in quite the same way that the Strategic Petroleum Reserve in the US has. So it'll be, you know, we'll be watching how smooth this process is and the rate at which barrels are released onto the market. But this is an important step, I think.
The price of crude, though, Julian, seems to be more dictated about what's happening in the Strait of Hormuz. There's an excellent Bloomberg Big Takeout about the plentiful and cheap weapons that Iran has that it could use to bully ships attempting to traverse it. As Matt pointed out, it appears that the Navy is not escorting ships through that. Iran may be looking at laying mines in the Strait of Hormuz as well. Julian, is there any visibility at all at this moment on reopening the strait?
No, quite simply. I mean, I think that, this tweet yesterday, I think, illustrates that very clearly. And there's been a lot of talk about escorting commercial vessels through the Strait of Hormuz, and people saying, well, of course, this was done in the 1980s and it was very successful then. The one obvious point to make is that nobody had drones in the 1980s, and so your escorts have got to be able to protect both themselves and the ships that they are shepherding through the Hormuz from drone attacks as well as more conventional attacks. And I think that adds another layer of complication. And for a ship owner who is going to be concerned about the safety of crew, the safety of their vessel, I think they need a much higher degree of assurance than they're getting at the moment. The market reaction to this tweet yesterday, I think, shows just how concerned people are about traffic through the Strait of Hormuz and how that needs to get moving again. And the IEA stock release helps, but it won't fully replace what's not going through Hormuz.
Julian, thank you so much for that. That's Bloomberg's Julian Lee. Elsewhere this morning, core inflation slowed a bit in February, which was in line with estimates. Futures spiked only momentarily on the print. They're back negative slightly again this morning. Let's get the details from Bloomberg's international economics and policy correspondent, Michael McKee. And I guess this report needs a big old asterisk on it.
It does.
Inflation before energy prices spiked.
Right. You guys remember tariffs? I mean, that was the story back in February. Oil's the story now, but these are February numbers, and they come in bang on as forecast with really no change in the year-over-year numbers. But if you look under the hood, there are tariff impacts. Good prices rose by 1% during the month. Software prices, and I'm not sure how this fits into that whole story about software stocks getting hammered, but software prices were up 6.5%. Got to be some sort of AI impact there. But apparel prices were one of the slowest rising of the categories that were tariffed. Now they're showing some movement. Housing, 0.2%. That's the bias that came in during the government shutdown, and that'll be holding down CPI inflation for another couple months. But gasoline prices right in the middle there, that's the story. Gasoline prices today, average price $3.58 on February 28th, $2.98. So as Danny says, this is not about oil. That started right after this report was finished, didn't capture any of the price-related changes. Housing costs biased down, so there's a little bit of throw out this number, look forward, because Friday we get the January PCE price index, which is what the Fed watches. It won't have any of this energy stuff in it, but that'll be what the Fed is looking for, and it's been running around 3%.
All right, so aside from the assassination, the play was really good. Appreciate that. Mike McKee on inflation before the war in Iran. We'll talk more inflation, and we will talk about the war in Iran, its effect on oil prices and the economy with KPMG's Diane Swank in the next hour. Also, Oracle gave an outlook that suggested there is little let up in demand for AI computing power. Bloomberg Tech co-host Ed Ludlow joins us from San Francisco. So, Ed, in terms of demand for compute, we know it's still there.
Yeah, and there's the one piece of backward-looking data and the three pieces of forward-looking. The key OCI unit grew 84% year on year, beating estimates. And this is AI-driven demand, right? It's very tangible. And so the formula that the markets are using this morning with the stock up 10% is to say, OK, the outlook for the fiscal year, which starts in June, is $90 billion of sales. That is beyond what expectations were. That's a good thing. Capital expenditures are holding at $50 billion for the year. So that puts to rest a little bit some of the concerns that the market had about Oracle being overextended and cash burn. And then in between that, there is a backlog figure, which is rising sharply to $553 billion. Basically, demand is far outstripping Oracle's ability to supply and the speed at which they can build data center. That story has been around for some time. But now the interpretation from the sell side, at least, is they look at that backlog figure from Oracle and say, well, you could also call that revenue visibility for the future. That's why I say 3 pieces of forward-looking data that the market likes.
And at the same time, after these results, the CDS on Oracle dropped to about a 1-month low. It still, though, is far wider than a lot of its tech peers who, like Amazon, has been able to go to the markets and tap the bond markets in a big way. To what degree is Oracle, with this huge spend that they want to do, just limited in their ability to do so because of the market pricing?
Yeah, the headline on the story is interesting, though, right? Credit risk drops 1 month low after strong results. It's just one moment in time. And what a lot of the credit portion of the market, separate from what the equity analysts are looking at, but the equity analysts are looking at it as well, by the way, like it comes up in conversation every day, is that on a longer term basis, how long does Oracle keep itself in negative free cash flow? On a longer term basis, you know, does the debt pile grow beyond the triple figure number? And that's kind of the way of looking at it. But, you know, the numbers that they posted for the outlook on revenue and the backlog do go some way to saying that the AI story is intact and that Oracle can maneuver this environment, how they're funding what is a necessity to build data centers, turn them on, and run workloads so they can book revenue.
Right. I'll remind you, though, that they have a 12% cost of capital and they're burning cash. Free cash flow is negative. So that needs to be turned around in a big way. Bloomberg Tech co-host Ed Ludlow is back with us in the next hour for a conversation with the Uber CEO, Dara Khosrowshahi, and the CEO of Zoox, with whom they just made a deal, Aisha Evans. Stay tuned for that interview. In terms of what's going on with markets right now, we are looking at futures that are down 67.74. By the way, I was looking at the 200-day moving average this morning. We're still a long way from it at 65.91. So we have a solid 180 points to get to that level. In terms of some of the single stocks that we're watching, Campbell's, the Campbell's company.
Yes.
They make Campbell's soup.
No, they took soup out of their name because they're like, we're not just soup,
Right.
There's so much more.
They make other stuff. I can't remember anything else that they make, but I do know they make soup. And the shares are down 5%. They missed estimates with earnings, and they cut their outlook as supply chain costs impact profits.
Also, a deal with NVIDIA this morning. They're investing $2 billion in Nebius. It's to expand their AI cloud capabilities in the coming year. And as with any NVIDIA investment, the company that they target gets a big rally.
And Starboard has taken a $350 million stake in CarMax. It sees an opportunity to accelerate the used car retailer's turnaround under incoming CEO Keith Barr. And you can see CarMax shares are up 6%. Plus,
thank you, Matt. It's the Starboard CEO. Look at this all-star lineup. The Starboard CEO is going to be joining me today on Bloomberg Deals. That conversation around 12:30, but some other big heavy hitters, including Paul Taubman, at the top of the show. So stay with us for open interest, and then come with us again on 12.
Yes.
For
well, you could
Deals.
watch the tech show, too. Just keep it on
all of it.
Bloomberg and turn on the sound when you see something interesting. Coming up, Wall Street, warning signs. JP Morgan is tightening the screws on private credit after marking down risky software loans. We'll have the latest next. This is Open Interest. Getting out of high interest, look what's making headlines around the world. Global leaders are moving to steady energy markets as the Iran war throttles oil flows through the Strait of Hormuz. The International Energy Agency is proposing a record emergency release of up to 400 million barrels. Brent crude briefly surged near $120 earlier this week before sliding back as missile strikes and shipping attacks intensify. U.S. regulators are preparing a sweeping rewrite of bank capital rules that could ease pressure on Wall Street and mid-sized lenders. The plan revises Basel III, adjusts big bank surcharges, and simplifies capital calculations for smaller firms. Officials say the moves could spur lending while also keeping financial safeguards intact. The proposals are set to be unveiled as soon as next week. And JP Morgan is tightening lending to private credit funds after marking down loans tied to software companies, signaling new stress in the $1.8 trillion sector. The move could limit funding to private lenders already hit by investor withdrawals. The CEO, Jamie Dimon, has warned that more risks may surface in the opaque market. And as a result, we want to take a deeper dive, Danny, into private credit.
And let's do that with none other than Silas Brown, Bloomberg senior private credit reporter in London. Silas, what is the thinking behind this? Because at the moment, it does seem like JP Morgan stands alone in marking down the collateral of these private credit funds.
Yeah, I think two things sort of leap out at me behind the news story. One, I think, often we report, and often it's kind of like widely understood that private credit is sort of somehow in battle with banks for deals. And while that is the case, private credit does have a kind of special ingredient oftentimes, and it is bank lending. I mean, a lot of the BDCs are levered about 1-to-1, perhaps a little less than that. I mean, there's kind of bank lending in the system, and private credit to a certain extent is reliant on that kind of capital. So I think it is striking when a bank, certainly of the stature of JP Morgan, makes some like curbs to its lending. The second thing that sort of jumps out at me is around software. JP Morgan has obviously taken a view that private credit lenders are not valuing or not kind of baking in the potential risk attached to the software loans that they hold when it comes to AI. And I think it's quite a kind of, it's a steadfast view, and I'm not sure, I'm keen to find out whether or not other banks will follow.
I wonder if, I saw an interesting line, and I messaged you with this from the FT story, that JP Morgan is almost alone in having the right to remark its private credit assets whenever it wants. Others have signed covenants and agreed to only mark them when they're like life-changing events, as if it were enrollment period for insurance benefits. Is that something that has held back lenders from giving investors a true look at what those assets are worth?
Yeah, I mean, I think it shows your expert news judgment. I mean, that struck me as interesting as well, that JP Morgan seems to have these kind of like special privileges over private credit funds that other banks may not have, which allows them to revalue loans and basically overrule the value of the debt that's being ascribed by the private credit funds and third-party providers. I mean, it's pretty striking, and it may well prevent other banks from following suit.
Silas, if this becomes more widespread, again, banks can't do this to the point you in Matt are making, but if in general it means that banks pull back in some of their lending to private credit funds, what sort of ripple effects might that have?
I mean, I think it could have extraordinary ripple effects. I mean, I would say, like, the way that, look, after post-crisis, what's happened is that banks have taken a view that the way that they can get exposure to this form of risky finance in a safer, more capital efficient way is to strike basically leverage facilities at the fund level, and so that they therefore extract a smaller margin than they would if they were having direct exposure to the underlying loans. And so I do think in this instance it's not like they are themselves participating at the same level of risk as the private credit funds and their LPs, and I think that is worth pointing out. However, I do think that a lot of this is to do with capital availability, and as kind of PIMCO mentions in a story today as well, a lot of this is to do with refinancing risk. And if private credit funds don't have the same capital as they once did or that they were expecting, that makes refinancing for these companies that have large leverage facilities that much harder. And I think that can obviously create a series of consequences that don't look great for the industry.
It's such a good point, considering so much digital ink has been spilled about the can kicking of a lot of these companies. Silas, thank you so much for joining us. As always, Bloomberg's Silas Brown. Coming up on the show, Katrina Dudley on how the war and rising risks in AI and credit are impacting her outlook. That's coming up next. This is Bloomberg Open Interest. Six minutes to go into the open futures. Little change this morning after dropping 0.2% yesterday. It's a market that is dictated by oil. Stocks will only rally if Brent crude finds a way to drop. We're at $90 a barrel and 30 cents, up 2.8%. 10-year yields, even though CPI came in line, the backdrop for it is energy prices that are pushing higher, yields up 2.7 basis points at 418.29. Joining us now is Katrina Dudley, Senior Investment Strategist of Franklin Templeton Public Markets. Katrina, is that what you're doing too? Much like this market is the first thing you're checking in the morning what oil is doing?
Yes, because oil's had a 6 standard deviation move. Just to put it in perspective, that means we'll never see this move for another 4 million years. So, it's kind of not just a once in a lifetime, it's a once in a multi-generational move. So I think you need to put that in the context when you're thinking about what are the ramifications of this. That's the first thing that we're looking at. The second thing is the expectations and expectations are for this to be a short war. So what we're seeing is like the immediate.
Hang on a second. How could you come to that conclusion, considering the fact that President Trump has asked for regime change, right? These Iranians could be laying mines through the Straits of Hormuz.
And have an insane amount of cheap drones.
They have an insane amount of cheap weapons. We're spending tens of billions of dollars to fight them off, and there's no off-ramp.
I think that, quite honestly, I do think from a humanitarian perspective and from a stability perspective, all ducks are aligning for this war to be as short as it possibly can.
Leaving instability in Iran for...
Assuming that you don't get a regime change that you are comfortable with. And so I think that what we're looking for is, and the reason it's important for markets is that it's the oil price. I mean, oil's gone from, it's gone up 45%. You're looking at numbers over $100 a barrel. You're talking about releasing strategic oil reserves. I think you put out the number of 400 million barrels coming out of strategic reserves. We've never done that before. So there is a lot of focus in terms of the markets about bringing oil prices under control. And why are people so focused on doing that? Well, if you look at the pillars that we went into this year.
All right, listen. We'll pick this up on the other side of this break because we have to take a commercial break. We're back with Katrina Dudley in just 2 minutes' time. This is Bloomberg. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We're looking at futures that are unchanged now after they had dropped earlier. S&P futures hanging around 67.90. NASDAQ futures also rising now 0.2%. Small caps are still down. You hear and see the opening bells behind me on the New York Stock Exchange. This is antimony, U.S. antimony. Which you may remember from the news cycle a couple of months ago, ringing the opening bell, and their stock has soared this year as a miner of critical minerals. On the NASDAQ market site, you've got Eagle Nuclear Energy flashing us the peace sign, although the shares have fallen about 50% year to date. So they've lost a lot of the value of that company really in one fell swoop.
Yes, I hear nuclear is coming back, though. We're all excited about alternative energy sources now. So
we hope to find something, right?
We do hope, because the market is trading on oil, but maybe the bright spot this morning that we have found is Oracle. Shares now up 12% at the open. Cloud sales showed sustainable demand for its AI products. The firm also raised its sales outlook. It is maintaining, though, $50 billion of spending for AI this year. Maybe it's a good thing it didn't upgrade that. I can't imagine the market would handle that well, because its CDS, yes, it's at a 1-month low, but their cost of capital, Matt, as you've been pointing out this morning, is still relatively high.
Yeah, we're going to talk to Anurag Rana about that in just a few minutes, because it looks like a growth story, but they have really got to grow past their credit concerns. Uber has struck a deal with Amazon's robo-taxi unit Zoox. Riders can book Zoox taxis on the Uber app if they're in Las Vegas starting this summer, and that will expand to Los Angeles next year. Of course, you can do this with Waymo taxis as well on your Uber app in certain cities, I think like 3. The CEOs of Uber and Zoox will join us at 10:30 a.m. New York time. Still with us is Katrina Dudley, Senior Investment Strategist at Franklin Templeton Public Markets. And without getting back into the whole war in Iran, let's focus on Oracle, because I think it's also a fascinating story for this market, considering we were so concerned not only about AI at the beginning of this year, but especially about software. And that sector has done better than any other since this war started.
If I take a look, you're right. The 3 pillars of an investment strategy as we went into this year was the continuation of AI spending and CapEx, where there were concerns about people pulling back or companies pulling back. The second second was the resiliency of the consumer, and the third was just this incremental income from tax refunds. And so if I take a look at Oracle, it really does reaffirm the value of AI and what we're expecting to see in companies. And if I have a look at what our company is doing, and I talk to other companies, AI is still really in the early stages of deployment. I think that we have really focused and gotten really good at automating individual workflows, making those more efficient, bringing those tools to our analysts. Now we're talking about what are the transformational impacts, and that's the AI spending that I think has got that longer term runway. And so someone like an Oracle, they're the types of things that you want to look at. And then finally, look, they made a commitment. They've continued that $50 billion CapEx spend on AI. I think the fact that they didn't increase it substantially is really what the market's rewarding them for.
It is remarkable that it took a literal war to make software attractive again, but it's a repeat of this playbook. We saw it post-COVID, we saw it post-Ukraine invasion by Russia too, that this tech software was a safety play. Does it still contain that attribute, or are we just falling back on an old playbook that might not maintain itself going forward?
So if you consider what was a safety play, it's something that doesn't have volatility and is stable spending where you can kind of eat and sleep at night, I think were the famous lines. And so if I look at these companies, we've had so many concerns priced into their stock. They still do have that legacy stable revenue base. And so I do think that that's why the market is characterizing them as safety. But don't forget, they are software stocks. Software is a discretionary expense item. So they are really an indicator of how we feel about the economy and how we feel about GDP growth. So if we are looking for positive GDP growth to continue, you would expect companies that are linked to GDP-like spending or investment-type spending to continue to work.
In terms of GDP growth, do you consider the Fed ready to cut or able to cut this year at all? Because if I do look out the forward curve for oil, it comes right back down to 70 pretty quick.
It does. I think we are still in the camp that the Fed probably cuts just to support that consumer leg of our thesis. I think it really comes from a position of inflation. So when you talk about oil prices, it's obviously people see it in the pump, and then we see it in the data and the inflation number going higher. We do think that there is some type of need for the Fed to be accommodative, and in order to help that consumer and help the market. So I think that we do anticipate they'll step in.
This is what I struggle with people who are saying, especially the way that markets are being priced in Europe and the UK, that if the inflation shock gets so bad, the Fed will need to hike. Presumably, if the inflation shock gets so bad that we theoretically need a hike from central banks, the rest of the economy will be faring very poorly.
Exactly, and that's the offset. We automatically say high inflation means that the Fed needs to kind of do a hike in order to control.
Unless it's transitory, of course.
And that's the reason that when we look at what you just mentioned, oil is expected to come back to $70 a barrel fairly quickly. You look at the speed at which people are stepping in to release strategic petroleum reserves. So everybody's doing everything within their power to keep oil prices stable. And to the extent that that happens, you may have a short-term, very narrow spike in inflation, but I think it is going to be short-term. People will look right through it.
All right. Yeah, I'm just graphing. You can use CCRV on the Bloomberg terminal to graph the forward curve for any commodities contract. And oil comes down quickly, but that obviously depends on an optimistic, I think, scenario.
I still think December's like 18% above its historical average, though. So something is being priced in there, just not $90 a barrel from here on out.
Yeah, no, absolutely. It's interesting that we're going to release 400 million barrels, even though the price at the pump is only $3.57. Like, what happens when we get to 4?
Yeah, well, there's not much left in the tank, as you would say, for them to do anything.
Literally.
But I do think it is an encouraging sign.
Remember $146? Remember during the financial crisis, we saw oil actually spike?
I know, but I remember oil when it was 20. So I mean, in my generation, it's gone all the way, all the way through. But I think what you're pointing out is the market is discounting this to be temporary, and that's where you will not see that huge spike in inflation that would cause the Fed, to consider hiking rates in order to control.
Katrina, this has been wonderful as always. Thank you so much for joining us. Katrina Dudley of Franklin Templeton Public Markets. 8 minutes into your trading day. Let's get a check on your equity markets. We are higher now. We are only up by 0.1%, and the breadth pretty pretty not good. 195 stocks are up this morning. The rest of them are down. Oracle leads the pack. Thank you, Oracle, for your wonderful earnings and AI demand. That's helping lift shares now 13.5%. That's easily the most since September. Tesla and Amazon having good days, too. Some autonomous vehicle news, specifically with Zox and Amazon. Maybe that's lifting Tesla. Not quite sure on that one. But the other big tech players doing well, too. On the downside, you have some of the staples not doing well. Eli Lilly, Philip Morris, P&G. This has been one of the really strange contours of this market. If we pull up what the sectors are doing, that we've had typically what are your safety sectors, like staples, just not performing. People are not going into that. Materials are also down, which maybe is not surprising. Consumer discretionary, that's at the top of the pile. Infotech, that follows shortly after. And then energy. So again, the picture you've gotten of what traders are fleeing to when crisis, volatility comes up, it's not staples, it's not healthcare, it's software and info technology, Matt.
All right, it is a very interesting picture, to say the least, and it gets more interesting when you factor in Oracle's earnings. It gets a much-needed boost from cloud sales and holds its AI spending plans where they are, so that it didn't increase CapEx plans on AI. That's what the market is happy about. But remember, this is a stock that before today had fallen more than 50% from its high in September. It's a company that has turned to negative free cash flow, burning $25 billion in the last 4 quarters, including 11 in Q3, and it has to pay a lot for that capital. We'll talk to Anurag Rana about it next from Bloomberg Intelligence. This is Open Interest.
Let's get you some top calls, the sell-side action we are following this morning. First up, Wells Fargo is starting Harley-Davidson with an underweight rating, saying that there is too much risk right now. The firm says that HOG has suffered years of underperformance with no clear relief in sight as demand remains poor, and it doesn't see any catalyst to change the story. Matt, just your thoughts on that real quick?
I'm trying to be a catalyst to change that story. If my wife would allow me, I could single-handedly boost the revenue of Harley-Davidson immediately.
I'm going to assume she doesn't want that, and no personal finance expert would probably recommend that either. Next up, Barclays, they are upgrading Nike, saying that the company is starting to turn things around. The firm points to better inventory control and a stronger focus on protecting the brand and improving profit margins as signs for that management is getting back on track. Shares up 1 1/3%. Finally, JP Morgan, they upgrade Oracle after the company's strong third quarter results. The firm says this quarter adds more proof that Oracle can grow faster while staying profitable. Analysts there also say that Oracle, their growth story isn't just about AI data centers. That gives it more ways to win, and it is up a very strong 13.5% plus some change this morning, Matt.
All right, let's focus in on that. Oracle's earnings impressed the market, and we've got Bloomberg Intelligence senior analyst Anurag Rana here on set with us. I had concerns going into this and still have concerns. When I look at Oracle's DDIS page on the Bloomberg, you can see the debt they have out. It's an enormous number, $137 billion. When you look at the WACC page, the weighted average cost of capital, it's a very high number. They've got a 12% hurdle to overcome. Yeah. And then when you look at the MODL page and model their free cash flow, it's very, very negative.
Yep.
All of that doesn't add up to a stock I think I would want to buy.
See, you look at it, it's all about context. When you look at earnings from Microsoft or Amazon, we saw CapEx actually rising for both of them. Same thing with Google. So we knew that all cloud providers are increasing their CapEx. Last night, they said they added $29 billion more of RPO on their balance sheet, but they're not going to raise the 2026 CapEx right now. They're going to work with clients who can prepay for GPUs, or they're going to ask the clients to bring the GPUs with them, which basically, puts less pressure on balance sheet going forward. Now, I'm not saying they'll have to raise more capital down the road, whether it's on debt or equity, but it's the magnitude of it. I think people are a lot less concerned about this morning than they were yesterday morning.
Does this also highlight that Oracle has a cap for its capital expenditures, that it won't be able to raise beyond $50 billion and get away with it? And if that's the case, what does that mean for their competitiveness if there is a ceiling?
So they're talking about they want to keep investment grade rating. So they have to take both of these in context. I was explaining this to an investor yesterday, and it's a very different case when you look at Oracle versus a CoreWeave for that matter. As an investor in CoreWeave, you know that there is a fair amount of volatility. But as a value investor in Oracle, you're looking at database business, you're looking at other software businesses. So it's not just the cloud business you're focused on, it's the entire conglomerate. So I think management's doing the right thing of taking care of those investors as well and saying, we're going to have a balanced approach of growth. It just doesn't mean that if we have demand out there, we're going to go bonkers in terms of raising capital.
Does a value investor in Oracle have to pay attention to what Larry Ellison's son is doing at Paramount Skydance? Because talk about a hurdle rate. They've got to overcome a serious cost of capital, and David's dad is backstopping that.
So look at it. He still owns 40% or somewhere around that of Oracle. He controls, he's probably the only founder that has such a huge equity interest in Oracle. I'm sure he doesn't want to see, their financial position be weakened as well right now. But at the same time, they have to play in the cloud market, because before the AI boom, they were honestly nowhere on the radar when it comes to when compared to AWS, Microsoft, or Google. Now they have the opportunity to add, let's say, overall $100+ billion in sales just in cloud alone. That's a big opportunity nobody wants to lose, but at the same time, you want to take care of your balance sheet along with it.
Just on that point, I think of earlier that data center that they were going to do with an SPV, I believe, with Blue Owl, that Blue Owl pulled out of. JP Morgan this morning is saying that they're reevaluating their loans to private credit funds because they don't know if the collateral is worth what they say it is, especially around software. It feels like capital is harder to come by and lending standards are tightening for companies like Oracle. Is that fair? Is it just harder for them to come by financing now?
But that's what they said last night, that, listen, we are not raising our CapEx. What we're going to do going forward, at least for the time being, is if a client wants to come work with us, they got to either bring their own GPUs or they got to give their money ahead of time.
But is that them just making an excuse for what would be really expensive money for them at this moment? Are they being more held back by a market that would make them pay a lot for any loans that they need? Or is it the truth that they're like, we're just being more prudent and looking at all the sectors within our business?
See, they're being more prudent because they have to raise equity, cash from equity also. The debt side of it is doing okay because they didn't have to, their debt offering was oversubscribed and they didn't have a problem with that. But they have said they're going to raise equity, cash from equity also. So they want to make sure that the equity holders are not punished because of the expansion that they have to go through.
Anurag, so great to have you and have you in person here. Wonderful to see you.
By the way, so as you were talking to Anurag about SPVs, I went on Ask B, which is a great Bloomberg function that, it's Bloomberg AI essentially, and said, does the DDIS page, which I've been using for 26 years now, include SPVs? And it does not, according to Ask B.
It's explicitly off-balance sheet financing.
So that's an extra, add to the $137 billion fund debt number, $40 billion in SPVs?
So the question here is, some of them are backed by the contracts that are given to them. So for example, if Nebius is doing a deal with Microsoft, Microsoft has made a commitment that this is what I'm going to give you over the whatever time period. So those loans, some of those loans are backed by that promise from a hyperscale cloud providers. So again, it depends on who the SPV is. It's, if it is from one of the larger vendors, then it's less of an issue.
All right. Wonderful to have you, Anurag Rana, from our Bloomberg Intelligence team.
Sorry for that excursion, little excursion.
That was a very fun excursion. We need to be careful with that word now. Okay, coming up, the rising cost of defending against Iran's missile barrage. We're going to discuss today's big take up next. This is Bloomberg Open Interest. Iran spent years building its missile and drone arsenals, spreading them around the country and concealing them. Now, American forces are having to dig deep into inventories of expensive, hard-to-replace interceptors to counter the barrage. It's all in the latest big take, and for more on it, we're joined by Bloomberg's global defense editor, Jerry Doyle. Jerry, this I gotta say, just reading the big take, which was so excellently done by you and the team, it really feels to stand counter to the narrative that's being pushed out right now that this war can somehow come to a conclusion soon and shortly.
Yeah, it's very hard to imagine a quick conclusion to the war at this point. And I think it is important to point out that the U.S. military has sort of essentially overwhelmed Iran in conventional terms, sort of destroyed its navy, destroyed its air force on the ground, degraded its air defenses heavily. But at some point in the very near future, the U.S. is sort of going to run out of effective targets to bomb. There's not much else exposed that they're going to be able to hit that will sort of affect the trajectory of the war. Iran, in the meantime, sort of has this large arsenal of ballistic missiles from before the war. They were estimated to have something like 2,500 before the war started. They fired maybe 700 or so. Many have been destroyed. They have a launcher shortage, but those missiles are still available to some extent. And they have a much larger supply of the Shahed drones, sort of a rudimentary cruise missile with long range that they've been firing constantly since the war began. Quite a few more of those than they have ballistic missiles, and probably they have a capacity to build more that will endure as the war continues. So on the one hand, it's easy to see how the U.S. might think that it's sort of destroyed or disarmed Iran. But on the other hand, the reality of the situation is that Iran has the ability to continue inflicting pain around the region almost indefinitely. And as we've seen in the last 24 hours, if they mount additional pressure on the Strait of Hormuz, that sort of inflicts pain on the entire world, the global economy, and gives them additional card to play.
And they have a ton of mines and great capability to lay those mines. Plus, I was struck by the fact, Jerry, in your story, that these drones that they're using cost maybe $20,000 to possibly $50,000 max. And we have a policy to use at least 2 missiles to shoot down those drones. You listed some missiles and costs that we use. Patriot PAC-3 missiles. Lockheed Martin charges $4.6 million each for those. These are single-use munitions, by the way. The THAAD, Lockheed Martin charges $12.8 million for each of those. The SM-6 missile, RTX charges $8.2 million for each one of those. These are far more expensive than a Bugatti Chiron. And I just wondered, reading your story, is that what they actually cost? Or is that what these defense contractors are charging us? Is there a huge margin for them in those munitions?
Well, I couldn't tell you exactly what the margin is. I mean, certainly there is one, right? They're not selling these at cost, right? They need to make a profit, and they do. I also think it's important to make a point that not all of these high-end interceptors are being used to shoot down Shaheds. The problem is that some of them were. Those missiles are really meant for defending against high-end aerial threats, such as ballistic missiles, such as hypersonic missiles, and that's the way that Ukraine has been using them. I think they've gotten about 600 since the beginning of the war in Ukraine, and have used them very judiciously against those high-end threats. In the Gulf, they have been used, especially in the early days, against all kinds of things, including the Shaheds, and so you see this mismatch, this price disparity. I think maybe the bigger impact on the U.S. military stockpiles is that these high-end capabilities that are not made in great quantities are being used up against an adversary like Iran, when they were really manufactured to confront a much larger, more capable adversary like China. Now, those aren't going to be available, and it will take years to replenish them.
Jerry, fantastic, excellent reporting. I really recommend that everybody go to the Bloomberg terminal, read the Big Take, or go to Bloomberg.com/BigTake to read Jerry's work as well. Coming up in the next hour, Diane Swank of KPMG on inflation risks, plus the AI software fight with Coupa CEO Lee Turner and both CEOs of Uber and Zoox on their deal. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Danny Berger. Stocks are somewhat positive today, only up about 1/10 after falling 0.2% yesterday.
Coming up, Brent crude hits $90 again. The IEA, though, proposes what could be the biggest emergency oil reserve release ever in a bid to cool prices that doesn't currently look like it's working.
Oracle, meanwhile, surges after delivering an outlook that signals no slowdown in demand for AI computing, and it won't be spending more than it already promised, shares surging this morning.
Plus, Fifth Third CEO Tim Spence breaks down the 3 keys to unlocking AI's value in banking. And I imagine Danny will ask him about M&A as well.
I just might. It is M&A Wednesday, Deals Wednesday after all. Some breaking news just crossing now. Meta is planning to use 4 new generations of its in-house artificial intelligence chips by the end of 2027 as it diversifies hardware resources. Let's bring in Bloomberg Tech's Ed Ludlow, who's been reporting on this story. Ed, this just seems like the move that a lot of these hyperscalers are making. Look for homegrown chips, rely less on the NVIDIAs of the world.
Yeah, remember that Meta is still one of the biggest buyers of both NVIDIA and AMD chips, but there is some merit in having custom silicon. So they basically have 4 generations of new accelerator. They're called the Meta Training and Inference Accelerator, MTIA. And it starts quite simply, like right now, in production is MTIA 300. And that is used to train the AI behind ranking and recommendations. So if you open up your Instagram feed, Danny, and you see a targeted ad, and you're like, wow, that's oddly specific to me, Meta sees merit in using its custom silicon to train that algorithm. But bigger picture, as they train more models principally on NVIDIA and AMD gear, running those models, the inference phase, the economics of doing that, they see a better opportunity to do their own chips. So now through the end of 2027, they will release 4 generations of it. And we were able to go inside the chip lab and check it out. And to all intents and purposes, it's real. And it disputes a little bit recent reporting that Meta had kind of given up on its own proprietary silicon.
Yeah, and just puts more pressure on NVIDIA. Ed, I look forward to your reporting on this. Your program, Bloomberg Tech, kicks off in just about 1 hour's time, and we'll hear more about Meta's chips entering the chat after we already saw a little bit of a wave being made by Google chips. And, of course, Amazon has its own chips, so it's getting to be a big fight. Turning now back to oil, IEA members agreed to release it looks like this is breaking now, agreed to release 400 million barrels of oil. This is what we had been reporting might happen. Now it looks like it is happening. Fatih Birol of the IEA saying oil market challenges are unprecedented, and that with oil trading at $89, this is Brent crude, $89 a barrel. It's pretty fascinating. Jeff Curry, Chief Strategy Officer of Energy Pathways at Carlyle, spoke this morning on Bloomberg Surveillance.
The damage is going to take months to unwind. But I want to bring it to the immediate. There is no policy response that can stop this ascent in crude. None. And yes, you hear this 400 million barrel headline. Flow rate is what matters. You know, the maximum sustainable flow rate is 2 million barrels per day. So 400, that'll take them 200 days to get that out.
And some of the gains on oil easing after that, and stocks moving higher this morning. But is it moving on the IEA or this Axios reporting that Trump has told them that there's practically nothing left to target in Iran, repeating again his refrain that the war will end soon. So stocks turning positive, 0.2%. Oil at one point moving negative, but it is still positive at the moment. Joining us now is Diane Swong, Chief Economist at KPMG. Diane, there's lots of volatility in the headlines, in the price of oil. How are you interpreting at the moment the move we've gotten in the past week and a half on oil prices? Is it enough just on its surface to impact this economy?
It certainly is enough to impact the economy. Obviously, for a temporary thing, we have fiscal stimulus coming at the same time. Unfortunately, the good news is that helps consumers absorb the cost. The bad news is that helps inflation stick around longer. And when we look under the hood of the CPI data as well, we're still seeing extremely strong service sector inflation. And in fact, the service sector inflation looks like it's accelerating. We saw that in December in the PCE. We're going to see it again on Friday for the January PCE. And the numbers that feed into the PCE for February will also show that. And that's very important because that's aside from these supply shocks. that we're seeing service sector inflation. In-home healthcare went up at a 15% rate from a year ago, its fastest pace on record. You have curbs on immigration colliding with the aging demographics of our society, and that pushing up prices dramatically in the medical profession, and particularly in in-home healthcare, but also hospitals, dental offices, all seeing increases. And of course, that was the one leg that held up employment at all in 2025.
Yeah, so it looks like immigration policy plus tariffs plus a war in Iran, all of these things are adding real upward pressure to inflation. What is the Fed going to be able to do? I mean, we have a meeting in 1 week, Diane, and for the rest of the year, how does it look?
It's getting harder and harder to justify another cut, and one even wonders if rates are going to be high enough to derail the inflation that we have. We hope this to be a supply shock that plays out over the course of months. It is months. We are not talking about, in none of our scenarios do we have this playing out rapidly in the course of weeks, even if the war were to come to an end within the course of 4 to 5 weeks. That does not change the disruptions to supply chains that are starting to mount beyond oil, because the Strait of Hormuz being closed really matters to a bunch of things out there in the U.S. economy, including prices of aluminum, which have soared. It's affecting production in Brazil as well. These collateral damages are similar in scope, not as bad, but similar to what we saw during the pandemic when everything shut down. And what we learned then, more than anything, is that it's harder to ramp back up once you idle production. And that is what I'm worried about going forward, is the price pressures due to that against the backdrop of the fiscal stimulus that we're seeing. We know that 1-2 combination is what helped to keep inflation not transitory, but more lingering. And we're not only still seeing it, we're still seeing it, and it's starting to show signs of accelerating again.
Would it be different this time, Diane? Because last time the fiscal stimulus coming from COVID, household balance sheets were strong, the labor market was really tight, so we saw consumers spend that money in a way that added to inflation. If you are now confronted with higher prices at the pump, a labor market that is not weak but is weakening, is the way that people spend or save the fiscal stimulus different this time around?
It will be. More of it will be allocated, of course, to everything from a harsh winter, which hit parts of the South, which don't usually get snowstorms, and they did. There was electricity outages, and there were higher energy prices that they had to pay in anticipation of what was going on in terms of the buildup in the Middle East of our forces. That's important as well, because even though they may spend less of it on discretionary items, it could help buoy inflation at a critical juncture when, frankly, if the Fed wanted to bet that demand would take down inflation, this undermines that narrative somewhat, because you still have that buoyancy from a very large fiscal stimulus, about $130 billion. And even though the inflation is a tax on the U.S. economy, it still doesn't match that size of the tax yet, of the tax cut. And I think that's important. What we will be testing, though, is the volatility in financial markets does undermine the confidence of affluent consumers, and we may be challenging the K-shaped narrative on the economy.
Diane, can I ask you about your view on the labor market after the disappointing jobs number that we had, I guess, just last week? It feels like years ago. How does the labor market in the U.S. look to you right now? Because you mentioned there isn't any immigration, and we do see still double-digit margins for company earnings. So it should be, I would imagine, this kind of growth that companies are looking for employees, but it doesn't appear that way in the numbers.
No, it doesn't. And I think what's important is I would argue the largest single factor suppressing employment last year was uncertainty. The only sector we saw gains in was countercyclical, which is healthcare and social assistance, which tends to add jobs almost no matter what. And of course, when we had a major strike in that industry and all the red ink outside of that as well. You saw red ink again for twice in 2 months' time in the overall payroll employment numbers. I am worried about the uncertainty that we're seeing today still causing hesitation. If firms only freeze hiring and don't even shed workers in this low hire, low fire environment, that shows up as a decline in employment, because the economy and the way the data is set up is it expects us to hire a certain number of employees on net every month and add new employees every month. Not only are we not seeing churn in the labor market, we're not seeing the ability of job hoppers to hop into better paying jobs like we did earlier in the expansion. The sort of premium to do that has evaporated. That said, we had no job gains essentially and no income gains all of the second half of last year, yet consumer spending accelerated. I would expect to see much weaker consumer spending in the wake of what's going on today, but it's still hard to push it through the ice given the fiscal stimulus in the near term, and that will matter in the back half of the year is whether or not we get a bit of a dividend if oil prices can come back down again in the back half of the year, in the latter part of the year.
Diane, this has been brilliant. Please come join us again soon. That's Diane Swank of KPMG. About 40 minutes into your trading day this morning, a check on markets and specifically oil. Brent crude, you can see, took a little bit of a dip. A couple of headlines that are impacting the price of oil this morning. For one, the IEA confirming that they are on course and they are working on plans to release 400 million barrels of oil of strategic reserves. But important to keep in mind, though it is the largest ever release, it is a temporary measure and something that experts have said is maybe a long-term impact of what's happening in Iran and the Strait of Hormuz. And then we had this, Matt, which maybe is moving markets more, and stocks are positive at the moment, that President Trump speaking to Axios saying that there's practically nothing left to target in Iran and repeating the refrain that the war with Iran will be over soon.
Yeah, it's really interesting. He does say that the U.S. is going to consider targeting new areas and new people in Iran. But again, I keep looking at this headline. Trump says war with Iran will end soon, according to Axios. I guess it all comes down to your definition of that word, soon.
He also said to Axios, anytime I want to end this war, it will end, saying that he has the authority, but Iran, Israel, there are also factors in this too, not just the U.S.
All right, coming up, we're going to discuss the impact of AI on the software industry with Coupa CEO Lee Turner. This is Bloomberg Open Interest. Getting out of high interest, look what's making headlines around the world. President Trump tells Axios the war with Iran could end soon, saying there's, quote, practically nothing left to target. He did confirm that the U.S. strikes destroyed 16 Iranian mine-laying boats in the Strait of Hormuz. However, Israeli officials say operations will continue as it prepares for at least 2 more weeks of strikes. The International Energy Agency approved its largest ever emergency oil release, 400 million barrels, as governments scramble to cool energy prices spiking from the Middle East war. Crude briefly surged near $120 a barrel earlier this week after traffic through the strait stalled. The IEA says member nations still hold over 1.2 billion barrels of oil in reserves. Oracle shares are surging after an 84% spike in cloud infrastructure revenue fueled by booming AI demand. The company forecasts $90 billion in total revenue next year. That tops estimates even as it pours billions of dollars into AI data centers. Despite investor concerns over heavy spending, debt, and job cuts, Oracle says AI demand still outpaces supply.
Let's get more on the software industry. Pleased to say joining us now is Lee Turner, the CEO of Coupa, a business spend management platform that's backed by Thoma Bravo. Lee, thank you so much for joining. And, you know, we've had many folks from Thoma Bravo, Orlando himself, on this program many times, and they've talked about working with your company and others as this AI fear percolates through markets. How much has Coupa had to change and had to adapt as the technology advances?
First of all, it's really nice to see you, Danny. Thanks very much for making the time. The reality is every single software company is adapting really quickly right now. And we believe that software companies with the right fundamentals, and I'm talking about data moats, really flexible architecture, born in the cloud, happy customers, great talent that are leveraging AI at pace should not be underestimated. And we are one of those companies.
In terms of demand, what are you seeing right now, Lee? I mean, in terms of the recurring revenue, annual recurring revenue that you get, what are you forecasting next year compared to what you saw last year?
Yeah, we're seeing tremendous growth. And here's why. It actually relates to the topics you've been discussing this morning. Huge geopolitical change, macroeconomic change drives need within our customer base for greater agility and greater efficiency. And they are also faced with what one could call a revolutionary time in the way that they deploy their own workforce. So customers are struggling to learn how to adapt to workforce augmentation or workforce elimination or workforce elevation. And they're trusting companies like ours to come in, understand the work that is being done, and help them determine how to transform their workforce.
But what kind of tremendous growth is that? Are we talking about single-digit percentage growth, double-digit percentage growth? I mean, at a time when uncertainty roiled most business plans at the beginning of this year, and businesses are focused on cutting costs to keep margins down because tariffs and immigration reforms are hurting their margins, how many more people are committing to your suite of software products, especially as ESG is less important than ever?
Right. So let's talk about the macro. IDC says that $450 billion of IT-related spend happened in fiscal year 25, excuse me. In 2029, they estimate that that spend will be well north of $1 trillion. And companies like Coupa are seeing the benefit of that. And again, customers are absolutely roiling with the complexity of the environment that they're currently working in. And they're reaching to companies that they trust, whose processes are embedded in their current workflow to try and help them adapt.
Lee, so a strong business that you're describing there at Coupa, you're probably very happy at the moment that you're not publicly listed, because even the strongest of businesses had a tough start to the year. I do wonder about the private side of things, though. You're backed by Thoma Bravo. Often for companies like yourself, the way that you leverage and get more money and borrow money is through private credit. There's been a complete rethink of just how much software companies should be worth, what their valuations are. We've seen JP Morgan, for example, write down the collateral of private credit companies that lend to software. Is it more difficult for you and the team at Coupa when you're speaking with Thoma Bravo to get more financing, to get lending? Has your cost of capital been impacted by the turmoil we've seen in public markets?
Let me begin with the beginning, which is we are very lucky to be in the private market at this time. And we have a wonderful investor. And they are encouraging us to move really quickly, like at rapid pace, and to leverage the investment that we need in order to emerge as a great AI company, which enterprise software companies with the right fundamentals and clear data moats and the ability to leverage their incumbent advantage can and will do. And we are seeing this again in our customer base. Our customers, 11,000 new suppliers on the buy side of our marketplace over the course of the last month, 2.3 million more sourcing events year on year, leveraging our technology, 32% more trade between EMEA companies as the tariffs were deployed. So we're seeing incredible traction in our customer base. If we stay focused on our customer with an investor who understands how quickly we can grow, we'll be successful.
Lee, thanks so much for joining us. The CEO of Coupa, Lee Turner. Still ahead, we'll discuss AI and banking with Fifth Third CEO Tim Spence. This is Bloomberg Open Interest.
AIA countries have unanimously decided to launch the largest ever release of emergency oil stocks in our agency's history. AIA countries will be making 400 million barrels of oil available. I repeat, 400 million barrels of oil available to the market to offset the supply lost through the effective closure of the strait.
That was the IEA Executive Director, Fatih Birol, speaking moments ago. It is the message coming from governments around the world and from organizations. We will do whatever it takes to try to lower the price of oil. Brent crude briefly moves lower, and that is quickly faded. 3.6% is the gain you're looking at. Same story for equities, not just the lines coming from the IEA, but President Trump saying that he can end the war soon. It is up to him about when it will end, and that they've hit most of the Iranian targets, that there's not much left. The S&P originally rallied on that, but again, it's a market that has now started to fade some of those headlines coming from the United States. Maybe it's just the threat of mines being laid and the facts on the ground.
I mean, there is a lot more talk about mines. I think the president himself brought that up in a Truth Social post, and there was a false report from the energy secretary that we had escorted a ship through the strait. That was deleted. It is not happening, so it's still a concern. Coming up, Uber users will soon be able to hail robo-taxis, though, from Zoox. The CEOs of both companies join us next. Uber will let customers hail robo-taxis from Amazon's Zoox, starting in Las Vegas this summer. For more on the partnership, Bloomberg Tech's Ed Ludlow is joined by the CEOs of both companies. Ed?
Yeah, thank you, Matt. We're talking about the Zoox purpose-built robotaxi. No driver controls, no steering wheel, no pedals, inward-facing seats. Starting in Vegas this summer, Los Angeles next year. And we're delighted to have Uber CEO Dara Khosrowshahi and Aisha Evans of Zoox with us. And Aisha, I've been fortunate to spend a lot of time with you in the last year. And you've always described Zoox as vertically integrated, control the stack, own the vehicle, own the app, own the service. You're going with a partner. What's changed?
That hasn't changed. We're doing that. And I've also told you that we'd be practical about our commercial deployment. This is a big market. And so talk to Dara. And in Las Vegas and LA, we're really looking forward to bringing our experience and sort of this way to ride to the Uber platform, in addition to also being available.
The way to ride is interesting. You know, Uber is not a ride. It is a platform, a marketplace for increasingly different kinds of rides. What is it, Dara, that you think you can help Zoox do that I guess they wouldn't otherwise be able to do on their own?
Well, we bring enormous distribution on a global basis. And I think that there's this narrative of it's either or, you know, either you go direct to your customer or you go through a platform. And the fact is, if you look, for example, on Uber Eats, you have some of the best brands in the world, whether it's a McDonald's or a Starbucks or Chipotle, having a direct interaction with customers through their own apps, but also using the platform to expand their distribution. And I see the same thing with Zoox as well. You know, Zoox is on his way to create one of the best brands in the business in transportation.
Which you've experienced recently, right?
Absolutely.
You went and took a ride.
It's a great experience. It's a purpose-built vehicle. And to have that experience on Uber, we think will only magnify what Zoox is bringing to the marketplace.
This is small scale in the first instance, right? You know, Las Vegas, and then where you're already active, and then LA. The mechanics of it are interesting, right? Because as a rider, you are not guaranteed in the first instance that you can choose a Zoox. It's algorithmic. It depends on the circumstances for you to have, I think the language you use is the opportunity to be matched with the Zoox. I guess supply in the first instance is why you've pursued that plan at first.
Yeah, but really no, because look, it's a platform. It's a global platform. It's available. You have all kinds of people who show up in Las Vegas. Some might know about Zoox, some might not. And the ones who don't probably know about Uber. So why not take advantage of that? That's really all it is.
This is early, but would you just explain, I guess, longer term what the business plan is? Is there a per ride revenue share agreement? How do you split the fare when you're able to charge a fare, Dara?
I think for us now, the focus is going to be the customer experience. We want to make sure that whether, obviously, the Zoox direct experience is going to be best of breed, but also having the experience through Uber is going to introduce you to the differentiated experience on Zoox as well. That's really going to be what Aisha and I are focused on. You know, I would say the economics take care of themselves over the long term.
data is going to be critically important here. So let's start, I guess, Dara, with what data sets can Uber provide Zoox that help them with scale and data sharing that you've got in place?
Well, we are certainly going to work with Zoox in terms of traffic patterns. And now Zoox is going to have access to that data directly as well. But I think the combination of the traffic patterns that we see and the customers that we see, whether local or international, along with Zoox's proprietary data, I think is going to help Zoox be even more efficient as an entity going forward.
Yeah, and I'll add to that also the experience of dealing with things, or just starting to deal with large events, things that Uber knows how to do in their sleep, and will essentially speed up our knowledge of doing that.
And also speed up deployment.
Of course.
You've always been very careful and cautious, I think is the wording that you've used. But is there now a sort of a different approach that working with Uber gives you to get the Zoox purpose-built vehicle? We can bring it up on the screen again. You know, it's a unique form factor in this country, and of course there was the big NHTSA news yesterday. But same question, what's changed in your ability to do that?
So I think the last time you asked me the question, I said, look, first, we want to be ready. Our approach will always be cautious and small and scale from there. What's changed is that we're deploying in Vegas. We know the market very well. We understand the patterns, and we think that partnering with Dara, Uber, and the team over at Uber will really help us not just bring the differentiated customer experience, but speed up how you deploy, how you operate on a daily basis, and we're looking forward to that.
Dara, Uber's shares are up 2%, but when the news hit, in pre-market, there was a really positive reception to this. What do you make of that? It's consistent with what you've already done. Capital-light model, partner with both automakers, the technology stack, and software names.
Well, we think autonomous represents the future of transportation, right? It's safer, ultimately, than human beings. We think it will make transportation available to more people. So this is just another step in our direction of an open platform for both human drivers and robot drivers who are safe, who are best of breed. And I think Zoox represents one of the top brands and top technologies and top experiences in the industry. And we're very proud to partner up with Zoox, and we're really looking forward to growing together.
Dara, what did you learn from your ride in Las Vegas as a market?
I think that obviously the Zoox experience is, I think, going to play in any market. But Las Vegas especially, it's a social place to go. People go to Las Vegas in groups, et cetera. And one of what was clear to me with Zoox is a differentiated experience in terms of the setup. It is a purpose-built vehicle. It feels, when you're inside, it feels so big and so generous in terms of the space. But then actually the vehicle itself is quite efficient. So for me, It was very interesting. I think Zoox is unique in building out this kind of vertical stack, purpose-built vehicle. And for me, the quality of the ride was absolutely on display for me.
Aisha, you are a member of Amazon's leadership team, otherwise known as the S team. You're actually ranked #1 in alphabetical order. I checked. A lot of questions I get for you is the capital plan. If you can get some more money from Amazon to accelerate your progress. Amazon's been active in the bond market this week. What can you tell us about your access to capital?
Amazon has been great. We're super happy to have them as a parent. Capital is not something I worry about. I worry about executing, delivering. Now that we're entering this commercial phase, this promise of a safer, cleaner, more enjoyable future on the road with our purpose-built vehicle that really gives you this delightful experience is really what we're focused on. I don't worry about capital at all. I worry about delivering.
Uber, Dara, is becoming kind of like the neutral marketplace for all kinds of AV providers, not just in the US, but globally. Have to ask, therefore, have you held any talks with Tesla about convincing them to take their plan, which is a proprietary ride-hailing service, but also purpose-built vehicle, to the Uber app?
We talk with all the various AV providers. Tesla obviously isn't at the point now of getting to no vehicle operator, but they are testing, and their technology is excellent. So we're happy to have discussions with them as well as other players. But today is about Zoox, and we're here to celebrate that.
Uber CEO Dara Khosrowshahi, Aisha Evans, Zoox CEO, here with us in the Bloomberg Tech studio in San Francisco. Back to you guys in New York.
Ed, thank you very much for bringing us that conversation. Bloomberg Tech's Ed Ludlow, and thank you as well to the CEOs of Uber and Zoox. Let's get a quick check on your markets this morning, over an hour into your trading day. And gains that we had seen for stocks and losses that we were looking at for oil have quickly faded. The S&P little changed. The NASDAQ, that's still higher, likely due to Oracle. And Brent crude back up at $90 a barrel. Originally, what you're seeing there had reversed after the IEA said that they're releasing 400 million barrels, and President Trump giving an interview to Axios saying that the war would end soon and that they're running out of targets in Iran. Joining us now is Bloomberg macro strategist Michael Ball. Michael, what do you make of a market that seems this time around very willing and very quick to fade positive headlines?
Yeah, that's the change in the last 48 hours. I think obviously there's been some credibility lost by the administration. There's continual worries of escalation. We haven't seen Iran really stop their behavior. There's also leadership concerns where we haven't really seen the new Ayatollah come out and give any statements. He seemed to be a hit and early strike. This is rumored. And the market and traders are basically chatting with each other saying, is this guy, is he stable? Is he in a leadership capacity? Or is there still sort of a void for anyone to say, okay, we will step down as well, as obviously President Trump has indicated he's looking to, again, get back to the table?
I guess that's maybe a hope, right? That he's been incapacitated, because a lot of strategists suggesting he's even more hardline than his father was. What are the other off-ramps that you're talking about on the MLive desk? Like, what else can we do besides retreat with a loss here?
Yeah, unfortunately, I think there is a view that there's still a chance for escalation to de-escalate, which is this Karg Island where the majority of Iran's oil revenue comes through. If we were to do a special ops there and take it over, then we would have leverage effectively on the majority of the regime's revenue, and they would have to then come to the table. So we're still kind of split. We're still talking about sort of escalation, which means that this is far from over. And as you're seeing in oil volatility, which is still around 10% a day, the markets somewhat agree.
I think in looking at the market moves, Michael, you've been very good at saying this is the positioning heading into this. It drove a lot of it. To what degree are we still in a positioning-driven markets, or has a lot of that been washed out now?
No, unfortunately, oil is still heavily call skewed, and we didn't see a lot of monetization in some of the actual institutional hedgers, meaning the real guys, versus sort of speculative positioning. Also, when we look at SPX, and we're seeing basically you can sell a put now out of the money and buy 2.2 or 2.5 calls. So everyone's still very defensive there. And although obviously Sunday gave a chance for a lightening of positioning, and we saw that, it's still a very hedged market in risk, generally speaking.
We have just 1 week now until the next Fed meeting. No one's expecting, obviously, any changes there. But how does it look for the Fed's prospects to cut rates?
I don't think it looks too good.
Not next week.
No,
I'm
I understand.
saying, like, this year.
No, I got what you're saying. And honestly, I'm kind of smiling because the Fed's backseated. I mean, they're effectively in a wait and hold position until we see this. And yes, we've heard from them, core is what the focus will be. We know how this trickles through, and we know the uncertainty it's going to cause. And also, we know this is an opportunity for businesses and firms to pass on prices again on top of the tariffs, which again creates a consumer headwind, which, you know, again, the mandate now will be focused more evenly between inflation and labor markets, whereas for a little bit there, it looked like inflation was cooling and they were going back to labor market concerns, which, as we saw in February, are real concerns.
I think even more interesting than the Fed decision is going to be Kevin Warsh's confirmation hearing. Yeah. Can you imagine him trying to go up there?
Will that be allowed? I think
Tillis is still sitting on it.
The White House has to make a deal before that happens, because Tom Tillis won't let it go through.
True.
He repeated again yesterday.
Yes, that's a very good point. But how
so there will be no confirmation hearing until the White House
but
makes
how
a
do
deal.
you, as a Fed nominee, assuming you get something like that, please envision this world for me, because I find it entertaining.
Okay, I'm along for the ride.
Okay, if you have a Fed nominee who's been contemplating inflation that's been running above target, and now you have higher oil prices, but he needs to sound dovish, or you might have a president who pulls his nomination.
So we do want to hear the hearing.
Yeah, I do want to.
We need to hear it.
I hope it happens.
More uncertainty and a market full of it.
Point very well taken. Michael, thank you so much. Bloomberg's Michael Ball. Coming up, Fifth Third's AI Ambitions CEO Tim Spence joins us next as banks race to adopt AI. That's coming up here on Bloomberg Open Interest. In his latest annual letter to shareholders, Fifth Third CEO Tim Spence offered a pragmatic take on AI, pointing to real productivity gains and tangible use cases. He also laid out the 3 key things he believes banks need to get right to truly realize AI's benefits. I'm pleased to say that Tim joins us now. Tim, first of all, wonderful to have you in the studio here. Great to see you.
Thanks, Dan.
And I know this has also been top of mind because you've been at RBC's conference where AI has been spoken a lot. I saw, for example, Citizens Bank talking about AI agents taking 50% of calls. What has been the sense, both in talking to other executives and at your institution itself, just how much is AI being implemented?
Yeah, I mean, I think the simple sense here, if you think about any new platform technology, there are 3 things to have to be in place in order to see broad-based adoption. One is there has to be a capability overhang, like the technology has to be fit for purpose. 2, the business case has to work out, so you have to be able to generate a reasonable return on the investment to put it in. And then 3, it's the hard work on change management and getting people to adopt it. And I think where we are at the moment is the capability overhang is very clearly there. The business case has become pretty strong. So you're seeing a real race to find ways to get AI embedded into core workflows across the sector.
So, I mean, how much money does it save you? How much work can it do in terms of, headcount that it could replace?
I mean, honestly, pretty remarkable. So our journey started a couple of years ago. I'm a big believer that I think as financial institutions, we should experiment more than maybe we have historically. So we rolled out AI productivity tools, starting with Copilot, Microsoft's Copilot, 2 years ago in April. Today, 60% of our employees use an AI tool that we provide at least daily. If you look at engineering, there's a requirement that they use AI when we push code. So 100% of the squads use it. 31% of the code that we released last year as a company was written by AI. And 80% of the unit tests, so the regression testing, the UAT, the things you got to do before you put new code into production, all automated with AI. And the byproduct of that is, like, when I got to the bank 10 years ago, we did 2 to 3 mobile app releases a year. We did over 400 in 2025. So it's not just expenses you're able to get out, it's the sprint velocities, it's your ability to bring new capabilities to market to customers that are game changers.
Do you set targets to up those numbers this year and next year, or is it just kind of like organically, naturally, it's happening regardless?
I only know those numbers because we manage them for the sake of ensuring that they go up over time. So our chief information officer told me before I made the trip out here that as of year to date, so as of the last 2 months, it's 40% of the code.
By the way,
26 is developed by.
When you have more code, because this is a big debate that's happening in the labor markets, because more code is being written, do you almost need more people to oversee that, or less because it's more efficient, or does headcount stay the same in that part of the business?
Oh, I think over time you're going to see, what I wrote in the annual letter, I really believe, is you will see meaningful, sustained, long-term gains in productivity. What you hope for is that what it supports is above market growth, right? So the goal for us has always been to drive growth. But if you look at a longer time frame, you just think about machine automation as a super cycle. Like Fifth Third's peak headcount before we closed the Comerica acquisition was in 2006. It was 22,900 employees, and we ended the year last year prior to closing Comerica at about 18,500, and the bank doubled in size during that time period. So we were 2 times the size with 20% fewer headcount to run the company. And that's just in working with conventional like classification AI as opposed to the transformers that we have now.
So your growth has been tremendous, and you think you can use AI to significantly improve margins. That's a up arrow story for the bank. I wonder about using AI for your consumers, for your customers. Because one of the things about the Citrini research piece that freaked everybody out a couple weeks ago is that he thinks it's going to remove friction from the system. And that can have positive effects as well, right? When I'm in my banking app and I'm looking at budgeting and I'm comparing prices, I mean, I can save money that way.
That's the thing, honestly, that I'm most excited about. I started my career in software. I was a little bit of a latecomer to the financial services sector. So I have a little bit of a product orientation just in terms of the way that I see the world. And the dream for us, as we have launched new digital capabilities over the past 10 years, was to get out of the business of providing tools that people used to manage their financial tasks and into the business of providing tools that did the jobs for them, right? And that really is what we're going to be able to do with AI, is we're not just going to be processing payments or custodying deposits or making liquidity available. We're going to be able to actually execute tasks on behalf of consumers and businesses. It's really exciting.
It is this real moment, though, where CEOs like yourself are having to grapple with this technology and understand what its use is. And then you add to that the other existential things happening in the world right now, which we don't need to rehash, but it has just resulted in broad market volatility. The regional bank index is now negative for the year after reaching a high level. How does that change deal making for regional banks? You closed Comerica. We spoke with you when you did that. Does it make deals more likely, less likely? Does it change the outlook?
Yeah, I mean, I think it probably makes activity less likely in the immediate term because you have to be able to value what you buy, right? And more likely over time. When I started in the business, there were 14,000 banks. I think there are 4,000 in the U.S. today. So there's been a lot of consolidation in the sector already. But there will continue to be pressure to drive unit economics, positively, to be able to produce the sort of diversification in your balance sheet that helps you to perform well in a more volatile environment, and in particular to be able to support the sort of investments in technology that are going to be so important.
I was just thinking about that. It's a massive amount of banks in the U.S. Other markets are far less fragmented than we are. What do you think it looks like in 5 to 10 years, Tim?
Yeah, I have a cloudy crystal ball, so you shouldn't take my prediction on that one. I know,
does Fifth Third, do you aim to be an acquirer as we see that number slim down?
We don't think of M&A as a strategy on a standalone basis. It's a means to achieve a strategic objective, right, or a strategic goal. So we care about being material in the markets where we compete, right? We're the second largest bank now in the Midwest by market share. We're the 6th largest bank, having been the 11th 5 years ago in the Southeast. And we're the 9th or 10th largest in Texas following the acquisition of Comerica. The goal is to be number 1, 2, 3, 4, or 5 in every one of those markets. I think we have the ability to get there organically, in particular because of the accelerant that Comerica provides across the Southwest in the U.S. But if we can achieve the same outcome, more efficiently and get our capital back faster for shareholders through M&A, that's always the thing we look at.
Tim, unfortunately, we're going to have to leave it there. Thank you so much for stopping by. Please come in whenever you're in New York City.
Happy to do it.
Love to have you here. Tim Spence, Chairman and CEO of Fifth Third. And on today's Bloomberg Deals, today at 12 p.m., we'll be speaking to a lot of people, Paul Taubman, Jeff Smith, among them. We're going to get Tim Spence on the show, too. I'm committing him to that right now. That will be at 12 p.m. New York time. You are watching Bloomberg Open Interest.
Let's get a look at what's going on in the markets after President Trump told Axio this war will be over soon and could be over soon. And the IEA says it's going to release 400 million barrels of oil. We have the S&P. It had turned negative. Now it's green, but still little change, up 0.1%, 67.88. And Brent continues to trade at more than $90 a barrel.
Coming up on tomorrow's show, Sarah Malik of Nuveen, plus the CEO of Mattel, the CEO of Vista Energy, and Dell CEO Michael Dell. This has been Bloomberg Open Interest.